Greetings. Today is Monday, June 15th, and I'm going to show you a little bit more about why we buy when we buy. But before I do that, I thought I would give you a quick update in terms of the broader markets. Here's the S&P 500. Remember, this is cap weighted, but we see the S&P did capture or find support at the 50-day moving average, so that's good news. It's even better news, in my opinion, or magnificent news, if we can go that far, that the Magnificent Seven also found support, but in particular, we want to note how far off of the highs we find the Magnificent Seven. So look at that price action right here on the right side of the chart and compare that to RSP. RSP is the equal weight version of the S&P 500, so it closed the week at all-time highs. And so my argument is this is a sign that the market's health is broadening out. It's not just the Magnificent Seven. We're getting participation across the board, which is a good sign. Now, we did see that little bit of a pullback, but we saw that RSP, the equal weight version, found support at the prior highs. That's good news, in my opinion. Now, looking underneath the surface, now we're going to look at IWV. This is the Russell 3000, which captures about 90% of the U.S. stock market. It is cap weighted, so we have to keep that in mind. But what I want to highlight is the advanced decline line is breaking into new highs as of the end of last week before price. So I would argue that's good news. We look at the same thing. We see the same thing in the Russell 2000. We have the all-time highs in the Russell 2000, and we have all-time highs in the advanced decline line on that same index. So that's excellent news. The last thing I want to talk about, and the main point of the video, is I want to share a little bit about why we buy when we buy. So on the screen now I have XLE, one of the energy sector ETFs. And in particular, I want you to note that from 2023 up until the start of the Iran war, which is right here in this circle, energy sector really didn't go anywhere but sideways. So that is not a strong trend. We would argue this is trendless for the better part of 3 or 4 years or even more. You can see periods of strength on the chart and periods of weakness on the chart, but overall no trend was persistent until the war in Iran started. So now we'll zoom in to this circle where you see that's where the Iran war started, and I would argue hindsight certainly tells us that's the beginning of the trend. Now, we're trend followers. We're not going to try to anticipate the trend. That's just not how we manage wealth. If that's how you want to do it, knock yourself out. But we're trend followers. And what that means is we're trying to get the meat of a move. We're not trying to get in at the bottom. We're not trying to get out at the top. That is not what we're trying to do. We're trying to get the meat of a move. But in order to do that, we have to find a spot where we feel like we can safely hop on a trend. Furthermore, we also need to verify to the extent that we possibly can that this trend is going to be persistent. So that's the question. How long do you have to wait before you are convinced that the trend is going to be persistent enough for you to hop on a trend and make a positive trade? Well, I would argue it's not after a week. I would argue it's not after a month, and I would argue it's probably not even after 2 months. Well, let's just assume that you decide I'm going to hop on this trend after a strong 2 months, because look at that trend. It just is very, very strong. So had you bought this XLE after 2 strong months, look where you would have been at the end. I think this is actually through Wednesday, which was maybe June 10th. A lot of volatility since March 2nd, and you would have been up about 2.5%. That's not something that we're really interested in hopping on, because we want topside volatility. We don't want downside volatility. And so to elaborate this one step further, this is what some people refer to as coiling. And I'm pretty sure I read that in my CMT studies. Mark Minervini, if you're familiar with him, he teaches this as a volatility contraction pattern. Same concept. You see from peak to trough is right here about a 16% swing. Well, then it contracts. It got tighter. Now it's about 7.5. Well, it did widen, so now we're back up to 9.5, but then right here it was getting even more narrow. That's things getting tighter and tighter. Also look at the bottom of this. Look at this trend line here. You see a low right here. Then you see a higher low, and then a higher low, and then a higher low. That is a positive trend. So as it is contracting, we're looking for a spot that allows us to say, well, we think this trend is going to persist, and if we're wrong, we're going to only have to risk a little bit. And so that's what we're seeing right here is it's getting tighter and tighter on the right-hand side. And so you can see the green dashed line. That was a price alert that I set at the end of Wednesday. I think Wednesday was June 10th, because that's the first spot that I would want to consider buying into this. So that's the first question, is where would we buy? That's the first spot of where I think we might want to at least consider it. But we also want to look at what we refer to as overhead supply. And again, this is nothing new. Many people teach this. I'm just trying to visually demonstrate it to our clients. So when we talk about supply and demand, we're usually talking about economics. This same principle applies to the stock market and the price of stocks and ETFs and bonds and things of this nature. Well, how do you see it? Well, when a price is moving up like that, that's demand. That is easy to see. It is very easy to see that XLE is in demand during this run up. What about supply? Well, supply is generally considered on the top side of the chart. And so if we were looking at this price right here, we see a little bit of activity above that line. Everything in that blue box is considered overhead supply. And so as the demand is being pushing the stock, or in this case, this ETF up, that supply, or the bears, are trying to push it back down. So that is the battle. The bulls are pushing this up. Well, the bears got involved here and pushed this thing down. Bulls are pushing it back up, and the bears, that is a bull and a bear battle. Sorry for that alliteration, but I do like alliterations. So this green dashed line, I would argue, would have been the first spot where we would consider buying this. But we could easily argue we might want to wait until it hits this top black trend line or resistance line, because look at the difference between what's price action is in the yellow box versus the blue box. There's obviously still some overhead supply here and some overhead supply here, but we do eliminate this price action that's in this zone here. So that is the concept of overhead supply, and where we might want to be interested in buying this right here, not before then. Even though we see strong demand here, and even though we see a positive trend here, we still want to wait and pick our spot and pick our entry to be a spot where we believe the bulls have actually won. Why? Because look what happened. This is today's price action. It never hit that price alert. That's Friday, and then this is today. So it's about 6.5% lower than that price alert. That is why we buy where we buy. That is why we do that, because we want to hop on a trend when we believe the trend has been persistent enough, but we want to hop on where we believe there's been a victory. The bulls have been able to declare victory over the bears. But if it doesn't happen, we're not just going to buy it just because the prior trend was strong. We want to hop on a trend that remains strong, and that is how we are using the evidence of price action to guide us into a security or ETF or whatever. Hope you find this helpful.